Okay, let's dive into this. Welcome to The Explainer. Today, we're taking a structured, objective, and deeply fascinating look at one of the most talked about and probably most misunderstood technologies of our entire lifetime. We are going to completely demystify Bitcoin. We'll explore its origins, exactly how the underlying mechanics work, and why it has sparked such intense, polarizing debate all across the globe. Whether you're a complete novice or you've been following the space for years, we're going to rely on the actual history and data to see what's really going on under the hood here.
Here is our agenda for today. 1. The financial rebellion. 2. How the tech works. 3. The rise of hard money. 4. Criticisms and counterarguments. And finally, 5. The ultimate survival test. Let's get right to it.
Section 1. The financial rebellion. To really grasp this tech, you absolutely have to understand the massive frustration it was born out of. Think back to 2008. The global financial system is, well, it's imploding. Lehman Brothers collapses, millions are losing their homes, and public trust in banks and governments is just rapidly burning away. And the absolute breaking point? A massive $700 billion taxpayer-funded bailout to rescue the very same Wall Street institutions that caused the mess in the first place. People were furious.
Satoshi Nakamoto drops a PDF. The premise was totally revolutionary. What if we had a currency, but we completely removed the banks? No governments to inflate it, no middlemen taking a cut, just math, code, and a public ledger. By January 2009, the very first block of this new system, the Genesis block, was mined, and it was widely seen as a direct protest against Wall Street. Now, for the first few months, it was just a nerdy internet experiment. Actually, scratch that. It was an experiment until 2010, when a developer decided to trade 10,000 of these digital coins for 2 pizzas. That was the moment. History's biggest financial revolution effectively started with takeout, proving that this magic internet money actually had real-world transactional value.
$600 million. Let that number sink in for a second. That is what those 2 pizzas bought for 10,000 Bitcoin back in 2010 are worth today. It was a massive declaration of war on the old financial system, and the battle was honestly just getting started.
Which brings us to Section 2, how the tech works. Because you really have to ask yourself, right? How do you actually run and update a secure financial system if there is no central bank sitting in the middle of it all?
The answer is the blockchain, and the best way to understand this is to imagine a giant notebook. But it's not just any notebook. This exact same notebook is copied across thousands and thousands of computers all over the earth that participate in the network. If someone tries to tear out a page or fake a transaction to give themselves more money, 10,000 other computers will instantly call them a liar because their copies don't match. So to fake a transaction, a hacker wouldn't just have to hack one single bank. They would have to rewrite every single copy of the ledger all over the world at the exact same time. That's the magic of the blockchain. It makes the system practically unhackable.
So, since there's no CEO or bank manager, who is actually updating this ledger? Meet the miners. The system runs on a concept called proof of work. Here's how it goes. Step 1. Miners run powerful computers that burn computational electricity. Step 2. They compete in this massive global math race to guess a highly complex, specific combination of numbers. Step 3. The winner of that race gets the right to append the newest block of valid transactions to the chain. And finally, Step 4. For their hard work and all that electricity spent securing the network, they win a reward, which is paid out in newly minted Bitcoin.
But here's where the math gets incredibly clever. It's called the halving schedule. Unlike traditional dollars, where governments can just step in and say, oops, we need more, let's print some, Bitcoin's supply schedule is perfectly predictable. Every 4 years, the mining rewards get cut exactly in half. Think of it like a pizza being shared with an ever-growing family. Back in 2009, miners were getting 50 Bitcoin per block. In 2012, that dropped to 25. By 2016, 12.5. Today, it's down to just 3.125 Bitcoin per block, and this exact pattern will continue until the year 2140. This shrinking, completely predictable supply is entirely by design.
Section 3. The rise of hard money. This fixed supply completely changes the psychology of how people use their money. It literally flips the script on traditional spending habits.
We are basically talking about easy money versus hard money here. On the easy money side, when governments face problems, they often just print more money to fix them. The inevitable result of that? Everyone's existing savings become worth a little bit less. Rents go up, groceries go up, all because the currency is being diluted. But then you have hard money, which is Bitcoin. There is no central bank, there is no money printer, there's an absolute mathematical hard cap of exactly 21 million coins that will ever exist, period. It rewards saving, patience, and thinking long-term because you absolutely know your slice of the pie cannot be inflated away by a politician.
To put that easy money problem into perspective, 40%. Between the years 2020 and 2022, the United States literally added 40% of all its dollars ever printed in history into circulation, just in that short window. Meanwhile, during that exact same period, Bitcoin's inflation rate actually dropped. In a world completely awash in easy money, people naturally began flocking to hard money.
And because of that extreme scarcity, Bitcoin has earned a really powerful nickname, digital gold. Just like physical gold, it is scarce, durable, and universally trusted without needing a third party. But unlike heavy physical gold bars, Bitcoin is incredibly portable. You can memorize just a 12-word seed phrase in your head, effectively carrying millions of dollars of purchasing power across any border in the world, and it is instantly verifiable on the blockchain.
And we're seeing this play out in the real world geopolitically. This isn't just theory anymore. In 2021, El Salvador famously made it legal tender, which allowed citizens to skip brutal 10 to 20% remittance fees with nearly free, instant transfers across the globe. In places like Nigeria, it's actively being used as a tool to protect savings and avoid financial censorship. In Argentina, Ukraine, and Afghanistan, it is helping everyday citizens escape rapid local hyperinflation and move their money safely. And it's definitely not just individuals doing this. Wall Street giants like Fidelity and BlackRock have completely changed their tune over the years, launching huge Bitcoin financial services for institutions.
Section 4. Criticisms and counterarguments. To truly understand this space, we have to look objectively at both sides of the coin. For every believer treating this like digital gold, there is a traditional billionaire yelling that it's a total fraud.
You've got highly successful traditional investors like Warren Buffett and the late Charlie Munger. They argue quite fiercely that Bitcoin is totally unproductive. Unlike a farm, it doesn't grow crops. Unlike an apartment building, it doesn't generate monthly rent. It just sits there on a computer. So to these traditional value investors, because it lacks physical yield, it is nothing more than a speculative dead end. Interestingly, JP Morgan Chase CEO Jamie Dimon famously called it a fraud back in 2017. Though, to be fair, it's worth noting his own bank launched a crypto wallet and Bitcoin services a few years later.
But here is the counter-argument to that. Are the traditional investors wrong? Well, not entirely, but they might be using the wrong measuring stick. Skeptics are basically judging it by old-world standards. They are looking for cash flow, dividends, and quarterly earnings reports. But the counter-argument is that Bitcoin simply isn't trying to be a company. It's a digital asset built purely for scarcity. It's meant to operate exactly like gold. Gold doesn't pay a dividend either, right? Its value comes entirely from its scarcity and the global consensus that it has value.
Section 5. The ultimate survival test. Beyond the criticisms from traditional finance, what are the actual existential threats that could theoretically destroy this network?
Well, the first major question people always ask is the ghost in the machine scenario. What if Satoshi Nakamoto, the anonymous founder who essentially lit the fuse and vanished like the Batman of money, what if he returns to hijack the system? It is estimated that Satoshi's original wallet holds about 1 million Bitcoin, which is roughly 5% of the total supply. People constantly worry, what if he comes back and dumps it all, or tries to alter the rules since he's the one who created it? The short answer is he can't change the rules. Bitcoin's code is entirely open source. Any changes to the network require massive global consensus from thousands of miners, developers, and node operators around the world. Even if the creator returned from the shadows tomorrow, he couldn't force a rule change on the network by himself. The system has simply grown bigger than its founder.
Then you have the other major existential threats. Quantum computing? The fear is that one day supercomputers might crack the cryptography. While current quantum computers are still struggling not to overheat on basic math, Bitcoin developers are already proactively working on quantum-resistant upgrades. What about government bans? Well, we already saw this ultimate test play out. When China completely banned Bitcoin mining, the decentralized network barely even flinched. The miners simply shrugged, packed up their computer rigs, and relocated to other countries. And finally, newer tech. Sure, competitors like Ethereum are a lot more flexible and Solana is way faster. But Bitcoin isn't trying to be the fastest or the trendiest. It is slow on purpose. It is simple on purpose, and it is overwhelmingly secure on purpose. It was designed from the ground up to be government-proof, inflation-proof, and time-proof.
Which leaves us with this final, really provocative question. After looking at its explosive origins in the 2008 crash, the elegant math of its ledger, and the absolutely endless barrage of criticisms and bans it has faced over the years,
Is Bitcoin's ultimate superpower simply its survival? Test after test, threat after threat, it is still here, ticking away, block by block. And perhaps that absolute, unyielding endurance is exactly the whole point. Thank you so much for joining me for this explainer. Until next time, keep questioning, keep learning, and as always, stay curious.